Alright guys, and here on our news it says Clarity Act update for XRP holders. These aren't just a few voices, right? Now, imagine 78 of the most powerful banking organizations in America pointing their fingers at a single piece of crypto legislation and saying, "Stop, this is going to drain our votes." This is not a conspiracy theory. This is happening right now. A massive, unified coalition of legal financial giants, including the American Bankers Association, the Independent Community Bankers of America, and 76 state banking associations, has sent a formal, urgent message directly to the United States Senate. They are targeting Section 404 of the Clarity Act because they are terrified of digital assets doing what banks have failed to do for decades, and that's give people a better deal for their money. Now, if you own XRP, or if you have been watching the rapid rise of Ripple's stablecoin RLUSD, these moves the goalpost entirely. So in this video, we are going to look behind the scenes at this massive lobbying push, examine the loophole that has Wall Street sweating, and break down why this direct attack on the crypto industry might actually be the ultimate green light for XRP. So let's start with our very first question about who are these 78 powerful voices fighting the Clarity Act. The sheer scale of this banking coalition is historic. This isn't just a couple of small town banks complaining about local competition. We are talking about a list of signatories that runs from Alabama to Wyoming. It includes massive national institutions and community banking groups alike. This major development was brought to light by crypto commentator BankXRP, right here, who shared the official letter's signatory pages here on X. BankXRP highlighted that this unified front is specifically demanding targeted changes to Section 404 of the Clarity Act. Their core concern? Traditional banks are worried that the current language in the bill is too weak to protect them. They fear that crypto platforms will offer interest-like rewards that will lure everyday depositors away from traditional savings account and into the digital asset ecosystem. So, as a market observer, my personal opinion on this is very clear. This is a massive panic move. For years, traditional banks have offered near zero interest rates on savings accounts while charging high fees. Now that the Clarity Act is on the verge of establishing a legal framework for digital assets, banks realize they can no longer lock customers inside their high-fee ecosystems. They are running to the Senate to beg for protective walls because they know they cannot compete with the efficiency of blockchain technology in a fair, open market. Now, what is the sneaky loophole causing panic on Wall Street? To understand why these 78 banking groups are so upset, we have to look back at the Genius Act, which passed in July 2025. That law officially banned stablecoin issuers from paying direct interest to their holders. Congress thought they had solved the problem. They thought, okay, if stablecoin issuers can pay interest, people will keep their cash in traditional bank accounts. But the legacy finance systems underestimated the creativity of the crypto space. The July 2025 ban only applied to the actual issuers of the stablecoins. It did not apply to the exchanges, lending platforms, or decentralized applications. Almost immediately, a massive workaround emerged. Crypto platforms started taking stablecoins, generating yield in the background, and passing those yields back to the users in the form of rewards and loyalty incentives. The banking associations are warning the Senate that Section 404 of the Clarity Act, in its current draft, does not do enough to stop this bypass. They want the loophole permanently closed. They do not want users to have any incentive to hold stablecoins for extended periods. They want stablecoins to be used purely for quick transactions, ensuring the wealth remains parked in traditional low-yield bank vaults. Now, in my personal opinion, trying to plug this loophole is like trying to stop a leaky pipe by wrapping it in a tape. The demand for yield is a natural human reaction to inflation. If people can earn higher rewards on a stable, secure digital asset than they can in a legacy checking account, they will always find a way to migrate. By trying to force stable coins to be transaction-only assets, banks are simply trying to delay the inevitable evolution of global commerce. Now, why is Ripple's RLUSD immune to this banking backlash? Let's talk about the master stroke from Ripple, their stablecoin RLUSD. While other stablecoin projects built their entire business models around attracting retail users with promises of high yield and passive rewards, Ripple went in a completely different direction. Since launching 1 year ago, RLUSD has exploded to a massive $1 billion market capitalization. What is truly incredible is that it achieved this milestone without ever offering a single cent of yield to its holders. Ripple designed RLUSD from day one to be an enterprise-grade utility tool. It was built for institutional payments, cross-border settlements, and collateral management. Because of this, its turnover velocity is incredibly high, second only to Tether. This means the money flowing through RLUSD is constantly moving, acting as high-speed digital oil for global liquidity rather than sitting stagnant in retail wallets earning interest. Now, here's my personal opinion. Ripple played the ultimate long game here. While other stablecoin issuers are now scrambling to hire lawyers to defend their yield-based business models against this new banking backlash, Ripple is sitting pretty. Because RLUSD is strictly utility-driven, it falls entirely within the permitted activities allowed under the current draft of the Clarity Act. Tighter guardrails and stricter rules will absolutely crush Ripple's competitors. But RLUSD is already operating exactly the way regulators want a stablecoin to work. Now, how does this clash directly impact the future of XRP? You might be asking, how does a fight over stablecoin yield affect my XRP? The connection is actually very simple, and it comes down to utility-driven demand. XRP acts as the crucial bridge currency on the XRP ledger. When institutions use RLUSD to move value across borders, XRP is the asset that facilitates the instant exchange between RLUSD and other global fiat currencies. The stronger and more legally secure RLUSD's regulatory position becomes, the more attractive it is for financial institutions. And as institutional volume on RLUSD grows, the demand for XRP to bridge those transactions rises proportionally. Furthermore, the Clarity Act contains language that would explicitly testify XRP as non-security. This would permanently remove the dark cloud of legal uncertainty that has kept major US institutional investors on the sidelines for over half a decade. In my personal opinion, this stablecoin debate is actually a massive blessing in disguise for XRP holders. If the banking lobby successfully forces the Senate to restrict yield-bearing stablecoins, capital will naturally flow toward highly liquid, utility-driven ecosystems. XRP is uniquely positioned to capture this flow because it does not rely on speculative retail yield. It relies on actual structural demand from global payments. Now, what is the realistic timeline for the full Senate vote? So where does we go from here? The road to passing the Clarity Act still has several critical steps. Before a full Senate vote can take place, the bill must be reconciled with the Senate Agricultural Committee's Digital Commodity Intermediaries Act. Once that is complete, the Senate version must be reconciled with the House version of the bill. The massive push by 78 banking organizations is a heavy political weight. Their formal demand for stronger stablecoin guardrails is highly likely to slow down the process. While many in the crypto community were hoping the bill would pass before the upcoming August recess, this coordinated intervention by legacy finance could push the timeline further into the latter half of 2026. Now, my opinion is that we should welcome a temporary delay if it means getting the rules right. The fact that the banking lobby is fighting this hard proves that they recognize the existential threat that is a clear, compliant regulatory framework possess to their outdated business models. The momentum behind the Clarity Act is too strong to be stopped entirely. It is merely a matter of when, not if, it becomes law. And finally, here's our overall conclusion. If we look at the big picture of this update, one thing is abundantly clear. The battle lines for the future of global finance has been drawn. On one side, you have 78 legacy banking organizations desperately trying to protect their depositor base by lobbying the Senate to restrict stablecoin yields. On the other side, you have the unstoppable advance of utility-driven digital assets. Ripple's RLUSD, with its $1 billion market cap, has proven that a stablecoin does not need to offer passive rewards to achieve massive success. Its high velocity and focus on institutional settlement make it completely compliant with the strict guardrails that regulators are building. And as the bridge currency that powers this entire ecosystem, XRP stands to benefit immensely from the legal certainty that the Clarity Act will ultimately bring. The legacy banks are panicking because the old way of moving money is dying. As market observers, we must look past the short-term delays and focus on the inevitable transition to a faster, cheaper, and more efficient global financial systems. And this finally ends our video. Thank you very much for watching and see you on the next one, or you might just as well check this next recommended video right here.